Okay, I know what happened already. Okay, yeah, so from here, right, we can already start beginning analysis lah. Let me just remove this. Alright. So, okay. So, we just do the usual suspects, which is like your gross margin. And then I normally like to make them pretty. So, equals to this, divide this, minus 1 percent. Oh, sorry. Percent, right? And then your net margin. You can hear me clearly, right?
Yes, I can.
Okay. Oops, sorry. Minus 1. And then percent. Alright, then
Why do you minus 1? It's a margin.
I mean, if you don't minus 1, you get. You're right. Yeah, you're right. I'm so used to doing growth rates. Okay, great. So 14, 13%. I mean, that's actually pretty good lah, right? It's pretty standard, but it's pretty good lah.
For retail.
Yeah, and you remember that they are how I say, they are
Selling a lot.
no, they are cost leader, right?
Cost leader.
Yeah, cost leader. You know what's cost leader?
No.
Cost leader means that you are trying to sell at the lowest cost. That's your competitive advantage. So
Right.
sorry, sell the lowest price, right? So if you are trying to sell the lowest price, obviously you need the lowest cost lah.
Yeah.
Yeah. Okay. Inventory, receivables, cash, blah blah blah. Okay. So this one we can do our standard, inventory. And then cash conversion cycle. So inventory is over cost of sales. Okay, this one you need to adapt the formula a bit. This one would be receivables over revenue times 365. Sorry. Times 365. And your payables would be and then this would be your sum. Then get rid of all this. Alright, so we can fact check whether they are bullshitting us or not. So let's go back to, where is it? There. Okay. Payable turnover days 6 days. I'm seeing 30 days. 23 days. Right, receivable turnover less than a day. Receivable, I'm seeing 17. Inventory. So I'm not sure if it's the same definition, but quite clearly they're using a standard definition, right? Key cash flow matters. Oh, okay. 64 and 2020. Cash. What's the disparity here? 125, right? So these are the kind of things that catch your attention. So either I'm doing something wrong in my one, so maybe I want to double check, right, whether I am the one who's wrong. Don't put words in your mouth. So revenue. Oh shit! This one is okay. So is it this where I'm wrong? Wait a second. Yeah. Because remember at the beginning I switched the years around.
Right.
So gross profit. So this is how you you know find mistakes. 103.
Oh. Oh yeah. During the MDA, they were doing it from left to right.
Yeah. Then
Statements is right
finance
to left.
cost, PAT 337. Yeah, see, it's wrong. I think the rest should be correct. So PPE is 436. Yeah, receivables is 127. Okay. So our payables 119. 1981. Okay. Let's look for EBITDA again. EBITDA. Okay, EBITDA is here. So 37. So 2020 was 694. I see. It's wrong. Okay. Right. So I'm not saying that I'm God. I can be wrong. So okay. But it seems like, even after fact checking, the numbers are still different. So they could have a different definition, I don't know. But, obviously I'm going to rely on my figures rather than theirs, right?
Right.
Oh, sorry, this is, yeah. Okay, yeah.
Oh, never mind.
This one plus this one minus this one. No, but still, their inventory days are different. So I'm not really sure what the disparity is. But normally right, this kind of audited and even unaudited reports, I'm the one who's wrong. It's not them. So you got to try and figure out where I'm wrong. I mean, right? Where I'm wrong. Let's just add this in. So average basket size. What's this? 22 points. This one is 22.2. Okay, 26.2. Okay, annual SSSG. Oh, you see, I'm wrong again. 1.4, 1.8%. This is percent. Okay. So right away you can suspect that this number is an outlier, right? Total transactions. This one is in million. Okay. Total transactions. This one is what? Average basket size. Okay. This is RM. So this one is in millions. So this one is 95.8, 1 over 1.3, right? Alright. Oops, sorry. You see, muscle memory. So, and right. I would also normally do all these, right? Because these are all very relevant. Stationery and sports items. Let's just have a look, So it's mostly household and furniture, right? Remember what I told you? Just going to impulse buy a shelf or something.
Right.
Hardware. Yeah, you see, it's like mostly these two. These two alone already make up like 50% of sales. Then others, not that
Probably
big.
a lot.
No, the thing about others is that it's literally everything else, right? So this figure is not very big. Like this one alone is more than this already. So right, you can like sort of attribute most of their sales to like furniture sector, right? Or DIY kind of house, like Home Depot kind of thing, right? This one would be the more Home Depot stuff, like your fix upper kind of thing, your plumbing, your your mechanic,
Which is quite fitting because Mr. DIY's logo is a hammer.
Yeah, I mean it's literally called Mr. DIY, right? So it actually is faithful to the namesake. Yeah, but this is quite interesting insight that most of their sales, more than 50% of their sales, is actually coming from furniture as well as. So when I say furniture, I don't mean just your sofas. I mean like your toilet, right? Your kitchen when you got your dish rack, your ladders kind of stuff, right? And then your hardware, which is your where you get your hands dirty, your spanner, toolboxes, right? Your garden hose, right? So 38 plus 8, even last year, right? Let's just calculate. So 18 plus 39. Like near 60% of their sales is just these things, which is quite, which means it's basically a Home Depot already lah. Because
Right.
my earlier assumption is that they're selling random Chinese junk, right? Like your serious impulse buy kind of stuff, which is like, your keychain, right? Your stationery, stationery is here, stationery and sports, keychains. So even electrical, right? These are like your phone stuff, right? Because I would imagine your power drills are in this area, right? So this one is more like your phone stand, your charger, kind of nonsense. And these are all the stupid Chinese stuff, right? So this one is your stationery, which is, to be fair, quite significant. These are your color pencils that you buy for your kids, right? Or your notebooks, I mean, you've been to a Mr. DIY store, they have a stationery section. And this one would be the true Chinese junk. Your random useless nonsense that you impulse buy. You will never buy. You will never like think like, oh, I want to buy this stuff. I'm gonna buy. This is their true impulse buy share, right? As a share of total sales is not that high. It's 25% only. Right? Most of their 60% of the sales is truly your DIY kind of items. Which means this DIY Home Depot business model, right, is something you might really want to look into when analyzing Mr. DIY, as opposed to, your China junk. So you see how I make assumptions about, which help me narrow down my scope, right?
Yeah.
So this is basically the whole, what you are doing for like 80% of the time or 75% of the time. Right, and the beauty of it is, you don't need to rely on what management is telling you, right? Not? You can actually fact check their bullshit, right? So it's very valuable, this kind of information, and you have to commend them for actually supplying it. You don't really have to, right? All right, so we are back here. So the first thing I will check is cash flow, yeah. Cash flow stats. Alright. Oh, sorry. Alright. So okay, so we have your FCF. So clearly it's good. And capex, FCF depreciation. Yeah, so you can see right, your FCF basically is reduced by depreciation. And seems like COVID never really affected them, which is expected for consumer staples. Okay, they're not consumer staples, but they're low-cost consumer staples. Yeah, low-cost retail. So they behave a bit like consumer staple despite being discretionary, right?
Yeah.
Then so you can see that working capital. Yeah, okay, this one is something I want to look into. Let me see. 12. So you see, right, you don't need to read cover to cover. I mean, when you are learning, obviously that helps, like Buffett mentioned. But when you're actually doing analysis, right, you don't have to, for in the interest of time, because 99% of the time, there aren't really a lot of red flags to be found. Like contrary to the popular narrative, right? Or popular, sorry, yeah. Malaysian companies tend to be quite follow the book, right? They're not like all super corrupted and like everyone has a red flag everywhere you can find. I found they're actually all mostly quite faithful. So finished goods, inventory losses. Okay. Let me see our receivables. So receivables is not that high. Gross margin 40%, net margin okay.
Where would they get their receivables from, though? I mean, it's a retail business.
Yeah, that explains why it's so low. So receivables is some ancillary thing. It's like
From
maybe they sell to distributors or
maybe they sell to corporate.
I mean I cannot really remember right now, but typically it's something like that. You know what I mean? But anyway, it's so small, which is fitting with the narrative of some miscellaneous item, so we can ignore it. But this one is
Yeah.
very interesting. So why is the inventory days so high? Okay. It's because they have so much inventory, right? Like it's very. I mean, it's not a red flag. It's very normal. You can see the inventory in their stores, right? So
Yeah.
yeah, it's expected, but
Inventory.
yeah, I mean, 150 days of inventory, that's okay lah, I guess. Cash conversion cycle, uh, okay lah, nothing special, nothing unique also. So what else? ROE, yeah, okay. So let's go for their performance statistics. So, oh wait, before that, growth. Okay, let's just do performance first. ROE, ROA, ROIC. So this is where you get to see the impact of capital allocation. So PAT divide equity, and then PAT divide assets. Oh, I didn't have assets. Okay, let's add it back. Okay, so cash is also something that is quite relevant. Assets 22521824, alright. And then liabilities 13761,483. So equals to PAT divided assets here, alright. And then PAT divide liabilities plus equity minus cash. So you understand the concepts, right?
Yeah.
Okay, so 93%? Are you serious? Serious? Wow, this is
The ROE is so high.
it's otherworldly, man. Hey, I didn't do anything wrong, right? Wait, let's have a check. Equity. Yeah, seriously, no. 340. Wow.
Well, how much is the equity?
Wait. Maybe it's the leverage. No, yeah, it's the leverage. Yeah, it's definitely the borrowings. Let me see. Where's the borrowings? Yeah, look, right? These
Yeah.
two. So they actually traded their borrowings for equity when they listed. So nothing to see here also. Alright, so this one is more steady state. So 40% ROE, that is phenomenal, isn't it? And even
Yeah.
the ROE is 15%. I mean, that is just amazing. ROIC 16%. So yeah, before we go on, let's just look at growth first. Okay, revenue, gross profit, gross net profit, what else? OCF, FCF, So normally we don't really growth their balance sheet. Dividends. Oh, seriously, man, they have no capacity to pay dividends. 100 million. Okay. Wow, not bad, not bad. I mean, even if I won't buy this stock because it's too expensive, right? It's still interesting to analyze them. Right. This. So I'm coming in blind just like you, right? So I actually don't know anything about this company more than you. Net profit. OCF. And then FCF would be. Okay, wait, I want to double check the EBITDA figure. EBITDA. Okay, they have tax also. Let's put tax here. Do you enjoy this?
Yeah, I do. But like, I mean, I'm sort of struggling because this is something that I have done before. Obviously, I mean, I've done them. I sort of knew what they were supposed to mean. I never really understood fully like what they told you about the business. But like I've done this like take down the numbers, calculate these ratios, and try to compare the ratios across companies in industries to have a rough gauge of how this company performs relative to its competitors. Like, is it better? Is it for worse? But then like it feels like all this is just like data stuff, which everyone can do. So where is the alpha coming from, right? And like I mean, like now that I'm saying this, I'm sort of thinking, all right, you're saying that it's either it is usually the mispricing of risks and not really the actual numbers, cause like everybody can arrive at the same numbers. It's more of the mispricing of risk where we find the valuation disparities, right?
Yeah, I know, but the thing is that you need to do this because everyone is doing this, right?
Yeah, yeah, yeah.
Like if you
Definitely.
don't do this, then you are the one at the disadvantage. So, can you see the font?
Yep.
Can I? All right. So we've got 12% revenue growth. Yeah, it's pretty phenomenal. Oh, we actually have 2018 here. Okay, let's add this in. 2019 would be this over this minus 1, and 2018 that would be this over this minus 1. Okay, we actually have EBITDA, so let's do that. Oops, sorry. Over this plus 1, and then okay, so this over this minus 1. So yeah, I mean, I know I did tell you that you don't have to reinvent the wheel, but there are certain there is a flaw to it, right? It's not like you don't have to do any work, lah.
Yeah.
Yeah. So like the people who don't do this, I probably wouldn't trust my money with them. You know what I mean? It's not judging them or anything. It's just that it's my money, right?
Yeah.
So okay, so let's give them a nice. Okay, so we can actually see that. Oh, see, muscle memory. We can actually see that revenue growth is pretty phenomenal. 12%. Yeah, so we can see the revenue is starting to taper, right? And
Yeah.
you might want to look into why is revenue tapering. Um, do they say MD and A? No, they actually tell you how they calculate SSG. 21 period. Yeah, so basically it's correct. Let me see. SSG for 12 months period can therefore only be calculated for stores. Shipping operation. Yeah, that's correct. That's correct. Alright, so nothing wrong with that. Standalone stores. Or what's the meaning of standalone stores? They have standalone stores and then they have what's the other one? Stores in malls and
So
shop. Okay, so standalone stores would be those shop lots, right? I don't know about it in Singapore, but in Malaysia they like rent out a whole 3-story unit, right? And then but it's basically the same thing. So maybe okay. So again, here is where analysis interpretation of information is more important than headline information. Standalone source is what you want to look for because their entire narrative is we are going to become the mall of the rural areas, right? So
right.
in the rural areas, you don't have a lot of actual malls. So I would expect if they following the narrative, you will see growth here and less growth here. Stores in malls and shopping malls, no, drop 1.8. Okay, so I guess it's correct. Um, okay, so you got to understand to put some context here, right? I think maybe we just go into the contextual part now. The what we're looking for, right, is that why you gotta ask yourself, right? Why is Mr. DIY share price uh, like this, right? What's wrong? Right? Why is the share price like this? You know what I mean? So 3.6 divide 1.6. It's gone up 2.25 times. So what's so cool about it? The cool thing is that they are like I said, they're supposed to be the mall of the rural area because in rural areas they don't really have that large shopping mall format, right?
Yeah.
So it's not really economical for a mall to do that because the geography in rural areas tend to be quite spread out. So it's better served by a small format shop than a large mall because people are not going to drive 30 minutes just to go to the mall, right? Like you can actually see that happen in real life lah, where if you happen to be in some more far off outskirt town, people who live there, right? Or if you have friends who come to the city from a small town to work, you ask them, right, what whether they go to malls very often. They will generally say that we don't really like to go to a mall is a big event, right? It's like a weekend family outing kind of thing, right? Because it takes so long to drive there, and also because of that prestige element, right? Because it's something special, so your whole family will go to that mall that is 30 minutes away to go and eat something nice, right? A restaurant like a Nando's or something, right? As opposed to just right stopping by a normal and pop shop for some groceries or something.
Mm.
So whereas because Mr. DIY's price point is low, and the things that they sell cater to the rural, I mean the low price point consumer, they can actually do a mall format, right? A large mall format, so they can set up like a standalone, 3-story, call it 10,000 square foot kind of area, and then just fill it with junk, and then people will just go there and impulse shop lah. And as I mentioned just now, you know, even I can see the appeal of, you know, impulse shopping there. But again, you know, from what we just saw, right, 60% of the sales are furniture and hardware. It's a DIY Home Depot kind of business model.
Right.
So, uh, that really makes me question the impulse purchase narrative. Because these things tend to be quite expensive, right? Like
Yeah.
your typical shelf is like $30. Your hardware is, I don't know, $20. Like these three I can see being impulse, electrical, stationery and others. But these two no, right? Like if you can think, if $30 is something I will not impulse buy, it's definitely something that someone with half my income will not impulse buy, right? So
Yeah.
yeah, I would. So again, you see that how I question the narrative, right? How you gain insight and interpret it. Let me see. Oh, okay, they have store count here. Good. Let's just add this in. So, store count. Store count. So this one is the total store count. So, 7, 3, 4, 5, 3, 4, 6, 7, 3, 5, 4. All right. So, oops. Okay. Oh, they even give geography. Okay, that's interesting. North. Okay, central. It's mostly still central, right? So this is urban area, right? Selangor. Brunei 4. Ignore that. East Malaysia is 104. So this is where East Malaysia,
The lower
and
income.
east and north coast, right, is where I want to see the additions are. Okay.
Right.
So you know you can go back to their previous annual reports and go and look for this number. So north 29. That's very encouraging. But central is still 61. You know what I mean? I mean, I'm not saying that if there's money to be made, you just, you know, forgo it out of principle, lah, right? But
Yeah.
this is what I want to see in the narrative, to check whether the narrative is true or not. Right? So this is how you verify whether management is bullshitting you. You know what I mean? And I think that's very
Right.
important, right? If you don't open the annual report, you just rely on a Bloomberg figure. I think it's very high chance you miss something like this, right? Okay, so let's try and
Will Bloomberg report stuff like the same store sales growth or this location thing,
sorry,
or
what?
like proportion of the sales that's going to furnishing?
Can you repeat your question?
Will Bloomberg report this kind of more idiosyncratic figures, like the location
No,
of the store?
no, because
No.
you know Bloomberg they have a standardized template, right?
Yeah.
So even their template where the tab says as reported, it's not everything in the annual report. So you will never get the same insight as if you actually open the annual report, right? And it's really not that
Right.
hard, right? It took me like what, less than an hour to key all this in, and now I
Right.
can start, you know, getting insight from it. So revenue, right? You can start seeing the revenue growth is just not going to be like this was like this. If like Sheng Siong did super well here, right? And Mr. DIY, okay, so here's where we start to see a bit of cracks emerge in the narrative. Uh,
That revenue growth is taking.
right, your share price is going up like this because it's billing itself as the rural, the rural shopping mall, right? Whereas as we've seen here, right, these are large ticket items, which is not something you can impulse purchase, right? So, which is, you know, right? It's showing here, right? It's not a Sheng Siong anymore, right? So, right? So
More small growth central instead of the rural areas.
correct. So this is not management bullshitting, right? I'm clarifying, but it's also definitely not what I thought it was, lah. Am I right?
Right.
So EBITDA, let me just check EBITDA. Yeah, so EBITDA is pretty much correct, lah. OCF, SCF. Oh, negative FCF. Why? Where is your FCF? Oh yeah, we saw that already because of depreciation. Where is depreciation, right? Depreciation increasing. So, like, you know, if you want to make it easier for your eyes to look at this, right? Or even, right?
Mm.
So these are the things you can do to make your life easier. So okay, now we go to the share price statistics. Oops, sorry. Okay, so which price? Oh, sorry. So 2020. Yeah, okay. I mean, this one is kind of useless. So let's just say, you know,
Excuse me, my mom is calling.
you can mute and then talk. IPO to what? To now. Okay, so this is now. So this will be now. So now it's 3.67. IPO, oops, sorry, it's 1.6 now. Okay. Alright, okay, earnings per share. So let's look for the share price. Let me see here. So something just came to mind, right? I want to see how much of their capex is being funded by borrowings. So okay, let's do.
So capex divided by change in total borrowings.
Not necessarily capex. Okay, what I mean is PPE and ROUA, which I imagine is the
Right.
bulk of their their assets. Short
And
term
inventory as well, though.
inventory.
I mean,
Oh,
they also have.
working capital, is it?
Yeah.
Typically people don't use borrowings for. So when you do get that, it's like it's like what am I doing? It's like Serba lah, funding working capital from borrowings. Like what bank will lend you money to unsecured borrowing? I mean, you can use a credit facility, I guess, a revolving credit facility, but people don't borrow term loans to fund their working capital. It's so
Right.
expensive. It's like what 6%, right? 5% interest to fund your working capital, right? Working capital is like what negative interest rate, right? So what are you doing? What am I supposed to do? Oh, right.
You got words in your formula.
Hey, sorry. Yeah. This is supposed to be. Sorry.
Oh.
Wings, and this one is supposed to not be here. Yeah, I got thrown off by the. Equity share plus this. Actually, we should use lease as well, right? So a lease is basically you are borrowing from the owner of the asset, right?
Right.
So yeah, so we can see that most of their borrowings is going to probably warehouses and stores.
Right.
Okay, another thing I want to check is how much rental do they actually have. So we can actually see from the annual the profit and loss statement, right? They have 24 here. So 24, what is it? And it's a significant item because the amount is big. So employee benefits. Why do we call it benefits and not salary? So notably, this is not administrative expenses, right? That one we can find it here. So there will be a note called profit before tax. Right, go and look for the note,
Right.
and then go and see. So this one will be the IPO expenses, maybe, or the audit fees, whatever. This is the IPO expense. Okay, so they don't actually tell you rent, right? This one is salaries. Capital commitments. Okay, so this one, right? If you know your accounting, it's not actually in the annual report. I mean, in the headline figures, right? In the three statements, you have to disclose it in the notes, but it's not. If you don't read the notes, you will miss this. You know what I mean? And you can see the amount is big, right? 108 million compared to current leases of 900 of 1 billion, right?
Yeah.
150 million. So 150 versus 1 billion, that's at 15%. It's not quite Amazon, early Amazon, but it's not immaterial either, you know what I mean? Employee benefits. What the heck is this? Wow. Sorry, 245. So you hunt for 245, right? It's probably this one. It won't be precise because between different ledger accounting, there's different accounting treatment somewhere here and there, right? So at our super high level where we are normally observing things, it's okay to be not precise. Sometimes you can even run in the hundreds of thousands, and so it doesn't really matter. Oh, this is thousand. Okay, that one was million. Okay, so it's not too bad. Okay, I was looking for this diluted number of shares. So P-net margin. Diluted number of shares. 1686182. Okay. 1000. Okay. EPS. Right. EPS.
So the 2019 EPS figure is quite irrelevant.
Yeah, it's quite irrelevant. Wait. Okay, this one is 20. Okay, this one will be 0.2. This one will be 31.7. 31.757.
So typically in an IPO, the original owners or the shareholder of the company, they're getting diluted, right? Assuming that they're not selling on the open market.
You are issuing shares, right?
Yeah.
So obviously you'll be diluted, right?
Oh.
Okay, so your market cap is based on your number of shares multiplied by your share price. So it's this one times this one. Okay, and this one is irrelevant. Okay, just to clarify, this one is IPO, and this one is IPO.
Right.
I think maybe I highlight it in red just to make it very, very clear. Okay, so what's this? This one is share price. Okay, this is your market cap. Am I right? $23. What's wrong? So number of shares is 6.277. Okay, I'm the one who's wrong somewhere. Times C19 minus.
And is the share outstanding the same?
It's not. This one is 6 billion. Why?
So on the annual report, 1.6 billion, on the website is 6. Wow.
No, you got
Why the
no.
share count?
No, this one normally includes everything like warrants and whatever. So let me just triple check. Here 6, right? Okay, never mind. Let's just use this one. But I'm just trying to figure out why this one is 1686. Yeah, they listed last year, right? Kind of weird. Never mind. Let's just use that one. So your EPS is actually different already. So it's 630. Sorry, number of shares 6301 into EPS would be 1.98 cent. Wait I can hear your motorbike.
It's outside one. So
You're,
sensitive on my.
you're on the
Let
ground floor,
me.
is it?
I'm on the second floor. Let me reduce the sensitivity of my mic.
Actually, you can go in the settings and put a background noise cancel, something like that. Okay, wait, let me just double check it. Equals to PAT divided by this one. Did you put that thing? The background cancelling thing?
Yeah.
Yeah, wow, it's amazing, man. I cannot hear anything.
Is it?
Yeah. Yeah.
Mine was previously on auto.
This one times times 100. Wait. Wait. Wait, let me just check if I'm doing it right. Oh, divide 100. So it's 53. Oh, this is quarter. Okay. Yeah, it's right. So, if you take 1.98 times 4, you get pretty much around the same thing. So it's 0. EPS. This one is correct. So we know the formula is correct. This is 10 times more. Yeah, okay, we're just gonna ignore this because this is clearly something is wrong. So let's just go with this. Okay, so it's 53 cents. So let's see whether it's correct. Equals to share price times number of shares. 23 million. Okay, what am I doing wrong? Share price times. It's correct. Alright, it's correct. So this is million shares, alright? And this one would be this one times million shares. 3.67 times 6 million is 3.67. Oh, it's billion shares. Okay. So it makes sense. Alright. Problem solved. Yeah. So, RM million is that this one times this one divide 1000. Alright, so uh, right. So oops. Okay, so we got 23 billion. We got share price. So we can calculate the PE ratio. So the PE ratio would be market cap divided by PAT. So it's 69 freaking times. Yeah. So right, like there's no hidden one-off items or something that can be like significantly improve in the change in the business model or something, right? So like 70 times, that is insane, man. Right? I mean, how much growth do you need to get to justify breaking even at 70 times earnings?
And the net profit is not really growing.
Net profit growth, where is it? Yeah, actually now that you think about it, okay, so they can actually justify this by saying that they are investing in growth. But let me see. But what the heck are they investing in? Correct. They could be front loading the depreciation and rental expenses and the lease expenses, right? Lease interest and depreciation, because they are front loading all the future stores in anticipation of future growth. So that could be possible, I guess. But even if you double earnings to get a normalized number, it's still 35 times. So I would say at best it's fair, right? At worst it's overpriced. And then don't forget they also have debt, right? What not just debt, they have leases also, right? So if you want to get okay, let's just do EV EBITDA first. Oops. And then we have your EVE. So EV EBITDA is quite interesting company to analyze. EV would be EV would be ROIC. So it's your okay, let's just calculate EV first. EV alright, equals to equity plus sum of these minus cash. You understand the concept, right?
I thought enterprise value was market cap plus debt minus cash.
Sorry?
I thought enterprise value was market cap plus debt minus cash.
Oh,
not
right,
the
correct.
equity.
So it's market cap. How do you reconcile this? But it's correct, right? It's million, right? Yeah. Holy crap. So basically that debt is irrelevant already. Right? You can pretty much just ignore the EV already.
How come?
Because the market cap is so much bigger. Look, it's 23 million and your total debt is like 1B. So you pretty much don't need to calculate this. I mean, I can show you.
So they are not
Divide.
doing the growth with debt.
Sorry.
Does that mean they're not fueling their growth with debt?
Yeah. No. okay, wait, let me just finish this.
You do what you need to do first.
35, 7, yeah. Yeah, no, 72 versus 69 is no difference. No, because as they are filling a group, so if you look at the equity, right, equity base is 876, whereas their debt base, right, is, yeah, let me just, so, equals the sum of this, lah. Oops. Hey, why is it? Okay, never mind. Wait, let me just do this. Oops. Okay, so you see, right, the debt to okay, very easy lah. We can just show debt to equity. Debt to equity. Debt equals to your debt base divided by your equity base. So, right, your debt to equity is more than 1, right? Which means that they definitely are funding business through debt. Why is this value? D87. Oh, right, there's nothing here. Okay. So, yeah, okay, so, we can actually just replace this with equity, right? You can see that. So from a business perspective, right, you definitely are funding the business through debt, right? It's not like 3.96, even now it's 1.36. 136% for a retail business is freaking high, okay? But like you're talking about 0.5 times, it's already, that would be standard, I guess. So this is like almost triple. But the thing is that people are valuing their equity at super high rates, right? So as a secondary market investor, you don't get the equity, you don't own the equity, acquire the equity at this price, right?
Yeah.
You acquire it at this price, right? So your market cap to equity is something like, right? Your market cap to price to book, price to book. P by EV. Let's just move this here. Equals to this over.
Why do you put an X at the back?
Times. Price to equity ratio is based on times.
Oh, okay.
Then
Yeah,
it's 26 times PB ratio. Okay, that is a tech stock already lah. You know what I mean?
Yeah.
So is this a tech stock with tech stock level growth? I don't think so. So on that measure alone, right? I mean, no doubt that this is a phenomenal retail business. Like the metrics are all just out of this world, which explains, right, the valuation the market is giving. But like 26 times, right? It's insane. It's like tech stock. This is worse than a tech stock already, right? So my conclusion is overvalued. Okay?
Huh.
Let me be dramatic a bit. Ta-dang!
Overvalued. So what would the catalyst be?
There is no catalyst.
I mean, if let's say we wanna short the stock, what would the catalyst be?
No.
Obviously.
Okay, here's the thing, right? In shorting, right, it's not like fundamental. When you are shorting, you are trading, right? You are flipping.
Yeah.
You are like reverse flipping the stock. You know what I mean?
Yeah.
So it's not the same as a fundamental analysis where you can be very confident of a particular valuation, a value. But it's very much similar to wait, dramatic a bit. It's very much similar to trading short term. You know what I mean?
Yeah.
the dynamic involved. So timing matters a lot for shorting because you know the market can be irrational longer than you can be solvent, right?
Yeah. Yep.
So so when you say what is the catalyst, that's a timing question, and I cannot give you a good answer. That's not my expertise. But I can tell
Mm.
you to stay away from this stock.
Huh.
Alright, happy with this analysis?
Yep. Maybe I should try this, and then like maybe every week I send a small, very brief overview for other people to criticize.
Yeah, that's a good idea. 5296 5296.kl. Alright, so to everyone else, hope you enjoyed this and learned something. Right, so I'm just gonna scroll through this so you can pause and you know if you want to like screenshot it or something. Okay, thanks everyone. Take care.